Hello and welcome to the latest episode of The Talking Tradesman. With me in the studio today, I have Tom from Sawbridge Financial Planning, and he's going to tell you all what to do with your money. So, Tom, let's talk.
Yeah, absolutely. And you know what? Saying let's talk is so important when it comes to money because in the UK especially, we don't.
Mate, you're spot on.
We
You are
don't
spot
talk
on.
about it.
It's a taboo. We feel uncomfortable talking about it.
Yeah, and I don't know if it's like a cultural thing or whatever it is, but people don't talk about money. They don't talk often with their parents, their family, their friends, and for that reason, people don't probably feel as comfortable as they could if they did.
Yeah.
And so I'm really keen on trying to get the word out about talking about money because I think
I love that, mate.
It makes people feel so much better when they do.
You saying that's kind of just been an instant light bulb moment where I just thought, you're right, actually. Like, none of my parents ever sat me down and sort of had any kind of conversation regards planning or investment when it comes to money. I think the most I ever received was like, don't spend it all at once. Was probably the extent
of
of
it done by you.
That's the one, yeah. It's probably the extent of my financial sort of help that I've had through the years.
So. And you don't get it through school either. You don't get at no point in your life does someone sit you down and go,
careful,
right,
mate, and get me on that subject.
But no one ever says, okay, you're going into working life and money's going to be a really important part of what happens for the rest of your life. Whatever you want to achieve, generally speaking, it's not the be all and end all. It's not going to be the thing that makes you happy. That's been proven. Having loads of money doesn't make you happy. It doesn't support. I mean, it's often people with mental health issues related to money have got the most, and it's like, what I mean? It can have an adverse effect, so it won't make you happy. But if you've got goals, if you've got things that you want to do in your life, if you've got places you want to visit, if you've got things that you want to do, money's going to play a part in that.
I think it would be pretty safe and fair to say that living in the UK, it might not make you happy, but if you have none of it, you're probably really fucking not happy either, are you? Like, it's in the UK, we haven't got that society really where you can thrive and live without money. It's not like we have the option to, do you know what, I'm going to go off grid, go and live in the woods and
be self-sufficient.
you can't, can you? Because somebody owns those woods. Somebody's had to buy those.
Exactly.
So yeah, it's like, it is vital for living. I understand money doesn't make you happy. That's a very true statement.
Yeah.
But the right amount of money, I think, buys you the freedoms in life that you can then use to make yourself happier.
And what it actually buys is time. That's the reality behind it. The more comfortable you are financially, the more time that you have. And that can be in various different ways. It might be that you're a little bit better off so you can afford to have a gardener. And so therefore you're not spending time gardening, you're spending time doing what you enjoy doing. It might be that you've spent your life investing so you can retire 10 years earlier. You've got more time to do the things that you love rather than having to go to work and earn it. And so what it truly buys when you look at it from that perspective is the time to be able to do what you really want to do. And so managing it in the right way allows you to live the life that you like to live or somewhere close to.
I like that, mate. I've said so many times, money can't buy you time. But what it does, it buys you the freedom to do what you want with the time that you've got, doesn't it?
Absolutely.
So there's a couple of questions I'll ask you on that, actually, as we move on, because it's a bit of a personal fascination, really, the whole mindset around, working your best years, I guess, to provide yourself that backdrop for the years where you might not actually have the quality of life. It's a little bit of a strange, can't remember, what was the book? You've no doubt you've heard of it. The 4-hour work week, something like that. What, come on, 8-minute work week, some small work week. But it was, I've absolutely butchered it. But it was talking about having micro retirements earlier in life. So like when you're younger and you've still got that quality of life, I guess physically, really, to pull out and maybe go for 2-3 months and have mini retirements, as they were referred to, but actually to spend some of your money and enjoy it while you can.
Exactly. And if you manage it right, then that becomes more easier than it would otherwise would have been. And I think so often people associate wealth with things. And so people spend their whole life chasing things to appear wealthy and forget about actually building some wealth to allow them to have the time to do exactly that. And so you could have someone, for example, who earns a really good wage each year and could afford, say you've got someone who's running a small business, they're making good money throughout the year, and they could probably afford to have a month and a half off in the summer and a month and a half off at the end of the year. Really lovely summer, really lovely Christmas. But that same person has decided that they want a Range Rover and they want, I don't know, a really expensive house, a much bigger house than they could have ordinarily have. So they
Yeah.
haven't got that time freedom to be able to do those two things. And it's that disassociation with true wealth that we have that leads us to not having that time
True
freedom.
wealth.
Mm.
Mm.
Do you see what I'm saying?
Oh, mate, I do. I don't, and it's resonating deeply to the point where it's hitting home, that one.
It's I refer to it as lifestyle inflation. So, have you ever heard that term? You ever come across?
No.
No. So, it's basically where most people go through this sort of process in their life. You come out of school or uni and you get your first job. And you don't earn very good money. You're just at the bottom of the ladder somewhere, or you're starting your own business and you're just getting it going.
Mm.
And then maybe 2, 3, 5 years later, you'll move up the ladder, or you'll be doing better and you're more established and you're making more money. And then you'll go, well, I'm making more money now. So what I'm going to do is I'm going to get a better car. Now I'm going to move house and get a bigger house. And all of those associations with wealth, which are looking good and having expensive possessions, and people do that. And each time that they move up the ladder, build a business or get a promotion, they do the same thing again. And so people, rather than taking stock and going, okay, I'm earning more money now, how can I make this work for me in the long run so that I can either retire earlier or I can be wealthier and have more time? They'll go, well, what do I do now? I'm going to just get nicer stuff. And you spend your whole life getting nicer stuff to appear wealthy because that's just what people do. And you never truly have the benefits of what you could have created by taking a bit of that away and living the same lifestyle but with a higher income so that you can build a different lifestyle in the future.
Perfect. Yes, it's really interesting, mate. I think so many of us, myself included, have got caught in that trap.
Yeah.
I mean, if you would speak to my family, they would tell you that I think for probably about the past 4 or 5 years, I have said every winter, I've said, I'm going to take a month off in the summer, or August or whatever it might be. I'm going to just get take the month off. If I'm honest, financially, I probably could afford to do it, but for the last 5 years, I have not taken a month off, mate. You get caught, and I think there's a bit of a problem again with the self-employed. It's quite prevalent of that scarcity mindset of, while it's there, I've got to take it. It's that fear of that job's coming. Am I going to say no? Am I going to say, do you know what? Sorry, actually, I'm not taking any bookings in whatever month, or I'm booked up further than that.
Yeah.
There's that fear of, but what if it dries up?
Mm.
I've got to take it while I can, take it while I can.
Yeah.
And that can translate to spend it while I can as well, to be honest.
It does.
We're jumping in the deep end. Listen, tell me a little bit about you, your background, and why you're qualified to tell people what to do with their money.
So a little bit about me. My whole working life has been in financial services. So when I was at school, still doing my A-levels a few years ago now, I
2-3 years ago.
Yeah, something like that, yeah. I decided I'm going to become an accountant. That's what I wanted to be. I thought, and the reason for that is probably associated with some of the things we've just talked about, where I thought accountants earn good money. I'm good at maths, so I'll go and do that. And then I got halfway through my A-levels and it bored me to tears. So I thought, I'm not doing this. Landed a job in the bank at 16, just like as a Saturday lad on the counter. And it really opened my eyes to the whole world of money that sits behind society. And I love that. I was sitting on a counter, and one minute I could be serving someone who's a millionaire, and the next minute I could be serving someone who, has really struggled and hasn't got a lot. And you start to see patterns between different types of people and realizing, often the people who came in looking $1 million often were the ones who didn't really have any financial security. Yeah. And often the ones who came in, you think, they look like a bit of a scruff. And you look at their accounts and you go, Jesus Christ.
Really?
Yeah, it's all the time. All the time. There's a phrase that we always used to use, which was money talks, but wealth whispers. And it's like, people who think that they are really wealthy and look really wealthy often have sacrificed actually truly being wealthy. Yeah. It goes back to the similar point. And
I've heard them, like Stephen Bartlett, talk a lot about that. He talks about the millionaire, billionaire switch over, and how you'll see people with a small amount of wealth will be the ones dripping in, the Rolexes, the Balenciaga, the loud designer, Gucci, all the, not knocking anyone that's wearing that. No, of course not. But it's those people that have normally got a bit of wealth but are trying to look like they've got a lot of wealth. Yeah. But those that are truly wealthy don't actually give a shit about trying to look wealthy because they know they are. Yeah. Which is why there was a famous picture, went there a while back. I don't know if you saw it, and it was like Richard Branson and Elon Musk stood in think it was Richard Branson's kitchen, and people were like, there wasn't one. They were all in like ill-fitting clothes, like baggy clothes. Branson's kitchen looked like it could have done with a lick of paint. And you got two of the most wealthy people on the planet, but very much obviously not concerned about looking wealthy.
Because they haven't got anything to prove to anyone.
Exactly.
And it's often people who feel like they have. And that's the thing, no one has got anything to prove. No one needs to prove that they're wealthy. No one needs to. Often people buy the expensive clothes and the expensive car to prove to others, look at me, I'm doing all right for myself. But in doing that, they're actually hurting their own wealth in the long run. But I digress from what the question you actually
exactly,
asked,
mate. This will happen a lot.
So I became fascinated with, seeing different people's financial situations, learning how to help them with their money and make better decisions. And so took the decision to finish my A-levels early, got a full-time job at 17 in the bank, and just worked my way through the ranks. So I was there for, just over 17 years. For the latter part, about the last 9 years of that, managing branches, so managing teams of people.
Bank manager role.
Yeah, that's it. Which was always the end goal. It was weird. I got there by about the age of 25, and it was weird because I had a long period where I was like, well, this is it now. This is what I thought the end was. And I sort of, for a few years, got really bored in what I was doing and stuff, and lost a bit of love for it. But spent all of my working career basically either helping people myself or helping others to help others to get their money get their money right. From all types of angles, from mortgage planning, financial planning, investing, business management. I went through all of the roles effectively. I did that or managed people who did that. And so that's sort of my career background, so to speak. That's where my knowledge sort of has been broadened over the years.
So essentially, you've always been in finance.
It's what I've always done, and then took a decision to step out of that a couple of years ago because banking isn't what it used to be. No one uses high street banks anymore. You've got like the 90% of transactions are done on a mobile phone now. So it was a really different environment, a much quieter place.
Something I hadn't really considered, mate, but it has. I'm going to ask you a quick question here. What do you think about the abolition of cash?
I have seen I was a business manager for a couple of years, and I've seen what it does for small businesses, the ability to use cash. And it's without cash, a lot of small businesses would have gone under much sooner than they maybe would have done. There's a lot of thoughts and conspiracy around the way money will be controlled if it goes cashless to a cashless society. I don't personally feel like that, and that's because I come from the world of regulation. I've always been in a regulated space. I've seen people think that governments and banks are out to get your money and out to do you wrong. I've seen it from the other perspective of the regulation is there to protect you, and it's to make sure that you're okay. So I don't think it would be as tragic as people think it would be if that's the way that it goes.
I've got to admit, I think most people in the trades will probably. So when I started in the trades, like 25 years ago, for entertainment purposes, there was a lot of cash. Your customers would very often ask the question. You put a quote in.
What do you do for cash?
How much for cash? Yeah, and it was almost like maybe one in every 3 jobs would ask that question.
Yeah.
Obviously, exactly the same quote because it all goes through the books.
Of course,
was always the answer. But mate, I don't remember the last time anyone asked. In fact, the last time I did get asked that exact question, my response was literally that, exactly the same. Because at the end of the day, I've got to get it in the bank. And if I'm honest with you, actually, these days having cash is a pain in the arse because so many places don't accept it now. Things are just very much changed. And I know, my personal belief is that cash is important because I think there's some credibility to the whole. A £20 note stays a £20 note no matter how many times it's passed around. But when you're using card machines and card payments, that £20 is slowly filtering back into the bank through the card processing fees. Yeah. So there's a part of that where I'm thinking it's important that it stays.
Yeah.
And there is, I'll be honest with you, mate, there is a bit of an irrational fear with me that should cash be removed, that you are then fully controlled. Like, what is to stop somebody turning that off or putting a hold or a bar on your account, as it were?
That could happen now, though, and you'd be equally
True.
stuffed.
Yeah, unless you had 50 grand in cash.
Yeah,
So
yeah, exactly that. But and it'd be a really weird world
not that I
if it
have,
ever.
by the way. I wish I had, but yeah.
Most people would already be stuffed if that scenario happened. Most money that people perceive to have doesn't actually exist in no form.
Yeah.
A very small percentage actually exists that you could physically get hold of. It's already stored in systems that could really be switched off and could be, manipulated by the system. If
What's the lending ratio, Tom? Is it 10-1 or 3? Is that
Are you talking about mortgages or
no? So in terms of like just money in general, so if somebody pays £100 into the bank are then allowed to lend out. Is it 10 times that amount or 4 times that amount?
Yeah,
I can't remember what
it
the stats
depends on
were.
the nature of what it's held in and the nature of what it's being lent out for.
Hmm.
So it's quite nuanced, it's quite different, but there is definitely a bigger margin. Most banks haven't got as much held on their books, if you like,
Yeah.
as the amount that is held in that bank.
Yeah, that's what I'm getting at,
there's like a ratio that they have to hold, which is probably only about 30-40%, I think, of the actual cash that they hold to be seen as viable as a bank effectively. So yeah, even the money that does exist on paper doesn't exist in the holdings because it's been taken and lent out or taken and invested or whatever it's been done. So the whole monetary system is already, if it could be switched off in that scenario, that scary scenario, that could already happen and mess people up. And cash makes a small amount of the actual transactions.
I would imagine. I mean, my life these days being quite open. I mean, I have or carry very little cash. It's just rarely do I ever use it now, and it's convenience. Everything is. So I'm a big advocate for wanting to keep it, but if I'm honest, I don't really use it a fat lot. So which I'm a massive hypocrite.
Yeah, it's. I personally hate carrying cash because I was surrounded by the stuff for years, and it did my head in. I mean,
do you know what? My wallet's on the table there, right? Tom can see my wallet, by the way. I've got one of those. You can see a little bit of cash there.
Yeah,
a little tiny bit. But I've got one of those new wallets. I can't remember what it's called, but it basically has no room for cash. It's got just one of the pop-up little buttons for your cards. It's meant to have like a card signal blocker built into it and all this kind of thing. I can't remember what the name of the thing is. But anyway, a modern day wallet, as it were. And it's got no room for cash. Certainly no coins.
Because most people don't use it. A lot of people who advocate for the use of cash will still not use it because it's much easier. You go and buy something for £1.27, you go flip out and get cash out where you just tap your phone. Most people go for the tap the phone option.
I think I like the romanticism of it, There's a romantic sort of attachment to cash for me because I guess generationally, I think somebody's alarm's going off out there. I think if you were to talk to like my son's generation, he has got no real upbringing of cash.
Yeah,
so
he's got there's not that nostalgia or feeling towards it. He'd much rather use Apple Pay, I'm guessing, for everything. For example.
Again, though, I do think as well when it comes to like spending habits, cash actually made you more reserved because I know that if I had say £100 in cash, I would notice it going down a lot more than tap 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 tap.
Yeah, especially when you can tap a credit card and that's got a limit that's much more than some people would have in their account.
Yeah,
and it's really easy to especially if you're doing something a little bit out of the ordinary, maybe a day out with a family or a night out or something like that, to easily overspend. Whereas if you had the cash in your pocket, you literally couldn't because once you've run out, you've run out.
Exactly, and you can see it dwindling down as well, and it's getting less and less. Your wallet's getting lighter, and you think, right, yeah, I might not have that extra, whatever it is.
Yeah.
It's I guess that all plays into the psychology of the financial system, really.
It does, and I suppose that there's definitely an element of, and it hasn't been confirmed, but the whole contactless payment has been brought about to encourage spending.
I don't doubt it for a minute.
Because the easier it is to spend, the easier it is to run up a debt or an overdraft or a credit card.
The whole idea behind it is let's make it easier to spend. What is easier than a tap? I mean, Apple Pay. There's no limit on Apple Pay, or if there is, it's about 10 grand or something. It's high.
Yeah, you can probably change it with the bank, to be honest. So if it was limited, you could probably put it up if you're spending. Went up.
So you don't even need a wallet anymore. You don't even need your card anymore. Just your phone. Everything on your phone, and just tap tap tap.
Yeah. I do like it when it's on like a website or something though. There's nothing more annoying. There's something in your basket. You get to the checkout section. Apple Pay's not on there. You go,
Do you know what, Tom?
Can't.
I've done the research on that, mate, because just to let you guys know, there's a new clothing range that's been launched for the Talking Tradesmen. Go check our website out, merchandise
Plug,
section.
yeah.
There you go. But I did a bit of research on that because I've changed over my store from Square to Shopify,
Right.
and looking into all that and the things like sales dropping when there isn't that instant click like Google Pay, Apple Pay, it's drastic.
I can imagine people do get
Yeah.
there because I do, unless I really want the thing myself.
Yeah.
I do it myself.
There's nothing worse than having to
Especially
actually
if
get
you're
your
on the
card
sofa,
out.
you've left your wallet upstairs.
Yeah, exactly.
I can't be bothered.
100%, mate. I think there's something to do with attention span as well, but there is nothing worse now than going on a website and having to actually get my card and put all them numbers into that, and then you hit it and it says incorrect card number. Oh, Jesus Christ. But yeah, it's so much easier now to spend our money.
Which is all the more reason to be closer to your budget, to be closer to making sure you know what you're spending. And there's still ways and means of doing that, even though you can just still tap with a card in terms of setting your accounts up so that you purposely avoid having a card that's linked to all of your main accounts and just separating it into one, so you've just got a spending account, and that's like you call it what you want, your pocket money account or whatever, and you put your budget into that, and then it works a little bit more like cash. It's when it runs out, and it will give you that sort of indication.
Do you know what, mate? It's those simple tips, isn't it? Because we can talk about how technology has made it easier to spend, but also technology, there are like plugging them, but I use Monzo a lot, which I'm sure you're aware of, but it's so easy, mate, with the apps and the side pots, and I've got accounts for every business, and it's very easy for me to keep track. I think I'm quite good with money, eventually. Not in the long term, as we'll talk about later. But it's very easy to split, like having tax pots and stuff like that. So yeah, that's a great use of the increased technology to actually help you rather than take it off you. So I think it's one of them, mate, isn't it? You can see the light and dark into any subject when you lean into it.
Of course, yeah, definitely. And if you use it right, it can be brilliant. It can transform the way that you manage your money if you use it in the right way. It can also really be really damaging depending on which way it goes.
Well, let's get into some of the tips and advice that you can give people, because that's why you're here.
Yeah.
So we've gone through obviously what your background is. I think he's qualified to give the advice there. So we've gone through all that, and the only thing, I guess, the step you took into giving out or going solo as a financial advisor, how did that come about?
So I always wanted to have my own business. I'd been in banking, I'd worked in business banking, I'd seen businesses, I've seen people sort of thrive really in their own environment, because you've got a little bit of extra control in the way you operate when you've got your own business. And so when I stepped away, I thought, well, I want to set up on my own. And it just made sense to stay in financial services. It was all I'd ever known, it was all I'd ever done. And it also allowed me to get back to the position of sitting in front of people and helping them. That had been lost in the bank because we got to the point where we didn't really have a diary open for people to come in and speak to us. Couldn't open accounts in the branch. You couldn't change your, do a mortgage in the branch often. And so I really missed that. I really missed sitting in front of people and looking at their financial plan and being able to say to them, if you just do this and this is how much better off you'll be in the future, and providing people with clarity, because it's a clarity that helps you from the perspective of feeling okay about your money. A lot of people will be doing really well in terms of what they're earning, and maybe even doing quite well in terms of how they're managing the money, but they're still worried about it because they're not really too sure in what they're doing, and is it the right thing, and is it going to work out in the right way, and how am I going to be when I get older, all of that kind of stuff. And so that's what I really love. And so I thought, I'm going to set up my own business. I'm going to go self-employed, go it alone, and get back in front of people providing financial advice. And it was a sort of a step further than what I'd ever done in the bank. I'd managed financial advisors, but I'd never been one myself. So I knew it really well. I had to go through the process of like a year of extra exams to be signed off by the FCA myself and all that kind of stuff. And so that landed me in the position where I was starting my own business. And for the first time, going through the trials and tribulations of running my own business, knowing what it's like to not know some of the fear of the scarcity that you mentioned, and thinking, I'm not really too sure how much I'm going to get paid in a couple of months' time. I'm not really too sure how this is going to go. And it's a real adjustment, I think. A lot of people in the trade are probably really used to it. A lot of people that I speak to, you land in most trades, I think, and you might correct me if I'm wrong, in a sort of self-employed environment where
Yep.
there's a lot of subcontract work. There's a
Yeah.
lot of people who just work for themselves and either build up their own private work business, or they'll be doing subcontract work for bigger companies. And so that fear of scarcity is probably quite normal and quite.
There's definitely a massive percentage of the construction industry that's self-employed, probably disproportionate to any other industry, really. A lot of, I mean, myself included, but a lot of us are self-employed. Obviously, there are those out there that work for bigger companies, but huge self-employed population.
Yeah.
And you're quite right. I mean, I've been doing it 25 years, so I'm definitely used to it. But there are still moments. There's still moments, pressure points, squeeze points, where you might have done a couple of contracts and you maybe. I mean, my own personal experience, if you're working in the commercial sector, you tend to get more people that might have you on like a 30-day or a 90-day invoicing system. And it's never 30 or 90, you know. It's almost like after 30, you can start chasing.
Yeah.
And then it might be another 14 days or 21 days. And if you've got lads that you're paying out, so it can, even though you're used to the unpredictability of it, there are definitely large points of pressure.
Yeah.
And leaning into that, one of the reasons why I was keen to get Tom in today to talk on the podcast is because one of the key factors when it comes to mental health in construction, and unfortunately the high suicide rates in construction, are linked back to the trigger point of financial pressures, uncertainties, and, you know, financially unstable situations or poor financial situations. So again, one of the things in construction is a lot of people that get into construction, I don't think I'd be unfair to say, are very good tradespeople, but have got very little business coaching knowledge and, you know, financial advice. So I've, hands up, I have never gone to a financial advisor. I've never taken financial advice.
Yeah.
So we're kind of just expected to know and to manage it. And then when it all falls apart, you kind of take all that pressure on yourself. So that's why, I was dead keen to get you in and talk to you about and try and get some tips on trade-based, but also just generally some of the things that maybe we should be doing that a lot of people in the trades aren't doing from what you've seen, and see if we can just, you know, make a bit of a difference to a few people.
Yeah, and I think I mentioned to you when I was talking about coming on, that I love working with tradespeople just because the difference that I can make to them and their long-term wealth and their long-term planning is normally huge for the reasons that you just mentioned. They're brilliant at what they do. They're good at making money, and they've got used to, you know, whether it's their own business or otherwise, doing what they do to make money, but often take their eyes off the ball with, because if you came through the route that I came through, I worked for a bank and everything was set up for me. My pension was in place, financial protection was in place, guidance around how to save and utilise my money was in place. So I was sort of really fortunate in that respect. But even people who don't work for banks, people who work for big companies, often will have a very similar setup. They'll have some sort of retirement provision automatically enrolled for them. They'll have some sort of, you know, financial protection. You don't get that if you're self-employed from the off. No. And so going from having none of that and having none of it for quite some time, and then having this setup where you feel much more secure, is great. And that I love being able to help people feel like that. But yeah, just a couple to pick up on a couple of things that you've said. So you said you've never had financial advice. 9 out of 10 people in the UK don't get regular financial advice. So that's 90% of people who are just making decisions themselves. And obviously people aren't stupid. They can figure a lot out for themselves. But having that guidance and that real, you know, expert look at your finances can really help. And one of the UK's biggest wealth management firms last year did a survey. And one of the things that they found, one of the questions they asked was, how did you feel afterwards from a mental health perspective and a well-being perspective? And 84% of people said after they'd had advice, they felt significantly better from a mental health perspective and a well-being perspective. Now, of course, that wealth management firm are going to be doing that because they're going to say, oh, look how good financial advice is for you. I don't think it's truly that. I think it's sitting down with someone to talk about your money and getting it straight in your head and knowing whether you're doing the right thing or not, whether that's with an advisor or otherwise, will help you to feel much better. So it's definitely right what you say about, you know, a lot of people don't have advice. A lot of people sort of just do their own thing and have to make it up as they go along, so to speak. But yeah, there's a couple of things specifically for tradespeople that I think are really, really important when it comes to managing your finances. And the reason I think it's important for everyone, but particularly important to tradespeople, and we were talking about it earlier on before we started up. People in the trade have got really manual jobs. Often, no matter which trade it is, you're contorting yourself, you're using your muscles all the time. You probably, whatever it might be that you're doing will have an impact on your body. And so therefore your work in life and the amount of years that you've got available to you to make money doing what you do is probably shorter than most people in most other industries.
Completely agree.
And so you need to be really, really keen on keeping an eye on that period where you want to either be able to slow down or stop completely. And if you do that early enough, and the sooner you do that, the better. So and it goes back to some of the things I was saying earlier, rather than having all of this extra money and spending it all and using it all on your lifestyle for now, absolutely live for now. But also just take stock of, okay, well, when might I want to retire? When might I want to slow down? When can I see my shoulder, my back, or my knees being knackered from what I do? And take some time out to plan it, because often people don't realise how little the amount that they might need to invest in their future needs to be if they start early enough to really make a significant difference for when they want to come to retire. And so that really, for tradespeople, more than anyone, in my opinion, needs to really be a focus. I'm making money now, I'm doing the job I'm doing, but I really need to be keen to make sure that my future is taken care of. And
100%.
when you do that and you do it early, well, there's numerous benefits to that. But for example, utilising pensions to do that. A lot of people, almost all of the tradespeople I speak to go, I've never had a pension. I've always been self-employed.
Yeah, I'm in that club, mate.
And for different reasons, some people feel a certain type of way about pensions and not being able to access them until you're 55 or 57, as it's going to become, and all that kind of stuff. But actually, they're great vehicles for investing in a tax-efficient way. You save tax when you pay into a pension. So every time you contribute one, your income tax bill goes down, or some of your income tax that you've paid goes into there automatically for you. And like I say, if you contribute for a long enough period, then it can really make a big difference to the outcomes that you get.
I'll tell you what, Tom, let's use me as a case example here, which I'm happy to do. I'm happy to be open. So my own personal life experience has led me to a point where I'm 40 years old now. I know I don't look it. But I'm in that category that we were talking about. So, to highlight my own personal life experience, I've been in the trades for a long time, took over the business 17, I'm now 40, that's 23 years. Pretty much significant graft. I'm at a point where I guess I'm sat here realistically thinking in 10 years' time, I do not or possibly cannot be on the tools because I don't want to work myself to a point where I've watched it. My dad worked into his 60s. My grandfather worked quite late. And I guess particularly with my father, I watched him work to a point where he worked all the way till he couldn't, purely because, neck problems, knee problems, hip problems. I want to step away from it before that. I don't want to break before I stop. I want to stop before I break. And I don't know why, but I've got in my head 50 after 50 because there's a couple of reasons, if I'm honest. One, I am getting the aches and pains now. It might even be before 50. I am getting the aches and pains now, but also I'm kind of conscious that probably at that age, I'm not going to be able to work to the same output that I currently do. So then I either earn less or I take longer on a job and therefore actually cost my customers more. So I'm not delivering the same value. Because am I really going to cut my wage? If I'm honest, probably not. So, and that's where I'm at. So I kind of think realistically, so I've got options, which is either A, get a new career, or B, I then go into like a management role within my company. Or C, continue doing what I'm doing, but be able to afford to take that step back, whether that's through slowing down or coming off the tools entirely or coming off the partially off the tools. But scene is set. So there's my position.
Okay,
right now I have got no pension, and if I'm honest with you, I've got no plan. So what I'm going to ask you is for a bloke who might be sat there like me, in that position, is it too late?
No, it's not too late because, no matter how long you've got, you can still make a big difference from doing nothing. So if nothing is your starting point, no plan and no pension is your starting point, and having 10 years on your side to do something about it, if you start and you start investing, then you can make a significant difference. Now, are you going to make enough difference to create a passive income from 50? it would be very difficult to, because you've got a much less timeline on your side. Let me do a couple of things for you. So I'll get my calculator out for a second.
Mate, carry on. Yeah, absolutely, mate. Absolutely.
Cool.
If you want to, do it.
I'm going to do two things. The first thing that I'll do is depress you, right? Because here we go.
This is.
I'll do it from two angles.
I feel like I'm about to get told off now.
Yeah.
What have you done?
Yeah, I'm gonna do it from two angles, right? The first angle is, if at 17 you'd have started contributing a small amount on a regular basis, where would you be now, and what would your retirement prospects be looking like? Let's do that first.
Yeah,
let's do the here's what you could have.
I was going to say, yeah. Here's the speedboat you could have had, and here's the rubber duck that you've got instead. Yeah.
But I think it's worth pointing that
Mate,
out.
100%.
It helps to make the point. It's 23 years. You said 17, you started.
I took over the business 17.
So 23 years of potential investing in your future. That if you look back, probably, really frankly and honestly, you probably during that period of time, if I, and this, it's really important that I point out, this isn't financial advice. This is just example purposes, because doing the right thing for you, taking the figures that I spoke now and just doing it for yourself might not be the right thing at all. But to use an example, during that period, give me an amount each month that you feel like you might have been able to invest in a pension. £150, £200. Would that be unrealistic per month?
I mean, for me at that stage, yes, because to be honest, when I was between 17 and 21, I was probably at my most wealthy, because I took over a business and I didn't have my own commitments.
Yeah.
So I had a lot of expendable at that age.
And here's what would have happened if you started it then. You would have been used to it and classed it as one of your outgoings. And so you would have built that into the decisions you made from that point onwards. You might have had a slightly different car, house, whatever it might have been, lifestyle, but you would have been doing it already and got used to it. So it would have been part of what you're used to paying out. Does that make sense? It would have, maybe not consciously, but you would have already done that and just factored it in so that it would have been there. So 200, should we use £200 for examples purposes?
Let me just cover one other thing, because I'm going to play this from an idiot's perspective.
Go on.
Just in case anyone's sat there, because I think, again, in the trades, maybe there's not full understanding of what a pension is.
Okay.
So just run me through just like an idiot's guide to a pension.
Okay. So a lot of people think it's this complex thing, and it is from the perspective of understanding the underlying investments, because all a pension is, it's a savings account for your retirement. That's the easiest way to understand it. It's a wrapper, like anything else that you might put your money into, that gives you particular tax benefits with the sole purpose of funding your retirement. So that's what it is. When you strip it back, it's an account in your own name. And a lot of people don't class their pension as part of their overall finances. They'll look at their finances on a page and they'll look at their savings, their current account there. You might have a loan, a bond that they've taken out at the bank, or all of these different things. And the pension will be separate and they'll never really look at it. But you should absolutely have it in that same picture, because it's your money that's sitting in a pot that needs to be doing its thing for your retirement. Okay. So it's a savings account for your retirement. When you pay into a pension, you can't take that money out purposely, because it's designed for your retirement. Current rules 55. 2028 is changing to 57. So I normally just refer to it as 57, because most people aren't that close to be able to do it. So you put your money in and you can't get it out until 57 by hook or by crook. The only way it comes out early is if you pass away, and then that money is passed to whoever you've nominated on that account. So that's another thing that people often misconstrue. Yeah. People think, well, if I pay into a pension and then I die, what's going to happen? Well, it just gets passed on to whoever you want it to be, your kids, your other half, or a family member. So it's a savings account for your retirement. You can't access it until 57, and the government want you to pay into it. The reason they want you to pay into it is because they've recognised a big problem on the horizon. In the UK, the birth rate's slowing, so less people are being born and less people are paying national insurance and paying into the pot. The people already alive are living longer. So we've got an ageing population who are taken out of the pot for longer when it comes to state pension. And state pension age has been pushed further back and further back. It was 65 and then 66. It's now 67. It's changing to 68. So anyone aged under 45 at the moment won't get a state pension until 68. The previous government was starting to, put a few rumours out about it being changed to 71. The state pension pot is under pressure. So they know that. And so they incentivise people to pay into a pension by giving you tax relief on what you pay in. So for a basic rate taxpayer, if you pay 20% tax currently, if you earn just over 50,000, you get that 20% of tax that you would have paid in on top of your pension. What that means in real terms it works out to be like 25%, and I won't go into the maths too much, but you paying 100, you get 25 quid on top for every £100 that you pay.
Who puts that in? The government?
It's tax that you've paid that gets redirected to your pension pot for you.
Right, with you.
If you're a 40% taxpayer, you get the £100 that you pay in, the £25 on top from the tax, and then a further £25 that comes back to you in your tax return. So it reduces your tax bill. You effectively get tax relief at the rate that you currently pay for every contribution that you make. So in real terms, what that means is every £125 that goes into your pension costs you in real terms £75 if you're a 40% taxpayer. If you're a 45% taxpayer, so for people that earn over 125 grand a year, they get 45% back. And so, first and foremost, you get that tax relief, which is a boost to your investment. And that is an incentive from the government to get people to pay in to their pension. Now, people who are employed might not get it in that way around. That's from a self-employed perspective. People who are employed and it just comes out before their salary, they get the same thing. They don't get taxed on that bit that goes in, but they don't get the bit back in their tax return that I've just mentioned for 40% taxpayers.
That's interesting. I didn't know that. So
most people don't. And you know what? When I sit down in front of people, and because I look at everything from a holistic perspective, I'll go, well, let's talk about now, the near future, and the long-term future. And people often go, I didn't really think I wanted to talk about pensions, but what do you say about that, actually?
Mate, that is exactly what I've just done, literally. My head. Anything that says tax relief, I'm like, tell me more.
Exactly. And so while it's invested, you can make as much growth on that as you can over the years. And while it's within that pension pot, you don't get taxed on the returns. Now, you might think that would be common sense. However, if you've got money in a savings account, you do get taxed on your interest once you've earned more than £1,000 a year or £500 a year if you're a 40% taxpayer. So a normal savings account, if that's your plan for your retirement, then a lot of the growth that you would have got, which would have been rubbish, by the way, because of interest rates being low, but if you've earned more than £1,000, then you would have been taxed on the interest as income. So it protects you from that during the course of the period that you pay into it. And then when you get to 57, whatever you've built up in there, you can have 25% of that tax-free, and the rest of it provides your income for the remainder of your life.
Okay.
And so the aim is to build a pot that will see you through for as long as you can.
So that is then, what is that, paid out monthly or?
Well, that's what people assume, but there's different ways to manage your pension now. So most people will use it as just an investment pot, because it's still, once you get to retirement, you don't have to. There's the two main ways that people take it out. One is by purchasing an annuity. And what that is, you give all of your money to an insurance company, and they say, based on your pot, we will pay you this amount every month until you die.
Right.
The alternative is to keep it in your own pension and manage it yourself with the help of a financial advisor. That's not a plug. I'm just saying any financial advisor can help you to do that. And it's an investment pot, and that remains invested and continues to grow. Now, by the time that you retire, that pot's much bigger than it was when you started out, and so that growth can really help to provide the additional income that you might need during your retirement. And you can manage that out in whichever way that you want to. You can take as much as you want year on year. You can take as little as you want year on year. And you then, like I say, it depends on where you've got to as to how long that lasts you. There's a rule that people say, you can look at your pension pot and go, well, 4% a year is what you can comfortably take out for it to be, service you for the long run. But depending on how it's invested, you might have made much more than that in growth over that year. You might be able to take that out without actually diminishing the original pot size that you had, because it remains invested and it's just an investment pot that's then invested for you.
Let me, I'm just going to throw a couple of things at you, where like things that popped into my head as you're talking.
Yeah.
My one concern, I guess, with those long-term investments is probably the inflation rate.
Okay.
So the fact that, I guess, money is losing its value, do they say about 8% a year at the moment?
No, about 2.5%.
Where did I get 8 from? Somebody's told me 8.
A couple of years ago, it was running at nearly 11%. Inflation was. We had that whole period where all of a sudden things shot up.
Yeah.
Liz Truss did a thing in government for a few weeks and put a bomb under the economy. Effectively, that's when all the interest rates started to go up and stuff. So it was running at 10-11%, but only for a short period of time. At the moment, the official rate of inflation is just around about 2.5%.
And what interest do you get on your pension if it's paid in, like year by year, APR?
Okay, so it's not an APR with a pension because it's an investment. And so people assume that it's going to be in a savings account like a savings account would be in the bank. And at the moment, the average interest rate that you might get on a savings account is 4.5%. With a pension, it's invested, and your money is taken and spread around the world for you by a fund manager who invests it into different economies, different companies, and make sure that your money's working for you. Now, with investing, you can't ever really predict the future. You can't say this is the definite return you're going to get, because there's a lot of factors. Worldwide economy performance. Donald Trump at the moment is making American shares go backwards. But generally speaking, and I do this with my clients, if you look at what returns you would have got from a savings account on average over the last 20 years, I'll use the graph as the example. So the graph starts at £100,000, just for round figures' sake. And with the average savings account that you would have got in terms of interest over the last 20 years, you would have made about £125,000. So £25,000, and it
On
would
top
be,
of the 100, yeah.
No. So 100.
Oh.
So 25 on top. Sorry.
Yeah.
So it starts at 100, ends at 125,000.
Okay. Yeah.
There's also a line on there which shows inflation, because inflation is really important when it comes to managing your money. If you're not making at least inflation, your money's going backwards in real terms.
That's what I'm trying to get at.
Yeah,
is,
you need to outperform inflation.
Yeah.
Absolutely, yeah. So on there, inflation, the average rate of inflation for that same 20-year period, means that your £100,000 would have needed to be £150,000 just to have stood still in the amount of buying power that it had. So the average savings account over the last 20 years would have meant, in real terms, you've lost £25,000. It doesn't look like it on paper. You look at it and go, "Oh, I made £25,000." But if you tried to buy the same amount of stuff with that as 20 years ago, you'd be 25 grand.
It's a perspective that you need to pay attention to, isn't it? And I think that has been a concern of mine when considering pensions is, well, if I put all this money in, there's a couple of things. There's that, which is, if I put my money into a pension, what says that my money hasn't actually devalued by the time it comes back to me?
So then the next line that's on there is the one that shows international equities. International equities just means shares in the ownership of companies around the world. And it just shows a sort of worldwide picture, basically. And if you had invested via a pension or via a stocks and shares ISA during that same 20-year period, with the average returns of the worldwide economy, your money being spread around the world into different companies, it wouldn't be the straight line that the interest was, because there's no fluctuation when your money's held in cash. It's a line that looks much more like that. And it shows on there, when COVID happened and things took a big step backwards, the 2008 crash, and all of these times where the stock market's been impacted. So it goes like that. The £100,000 ends up worth about £700,000 in the same period, because it's been exposed to market growth. Right. And you can look at the last 150 years since stock markets have been a thing at the average growth rate. And that's the last 20 years my graph shows, but you can take any 20-year period and it paints a very similar picture.
Okay.
And so when you've got enough time on your side, having investments at the right level of risk, it's got to be at the right level of risk, the right volatility level for your circumstances, based on your investment experience. But when you've got time on your side, it means you've got time to ride those fluctuations in the markets and benefit from the periods of growth. Some of the years of growth during that period would have been like 30, 40%, because the world picks up and grows and.
So when I've heard, I can't remember when it was, a while ago, there was a lot of talk of pension crashes and people that had paid into pensions, when they came to mature, they were worth a lot less than they were expecting. Would that be because they had cashed out at a time of a market crash, or how does that work?
So potentially. So if someone had a pension, say for example, you were invested in a pension just before COVID happened. COVID was one of the biggest, backward turns in the value of the worldwide stocks and shares ever, probably in what felt like an overnight period, because the world just stopped and grinded to a halt. So if you had invested just before that happened, or if you had your money in a pension just before that happened and you planned to retire the year after, you would have taken a significant loss if you were invested heavily in equities. If you had a financial advisor, they would have told you, you're a year out from retiring, let's take all the risk out of it, let's change it back to something which has a low equity exposure, so you take all the volatility out.
Okay.
But if you were heavily invested in stocks during that period, then you would have taken a big step backwards in the value of your fund. However, if that was the case, when the world started back up again, you would have probably done somewhere in the region of doubling your money within 2 years of that point. So it recovers. There's always a point where it steps backwards. We're never that far away from the next war or flipping, financial crash of some description, or recession that happens. That happens, and it happens all of the time. But if you've got enough time on your side, then you can utilise equities to gain extra growth.
Okay.
And you have to do it in a way, like I say, and this is where it comes down to, if you're not sure how to do it, getting some advice will guide you on whether it's right for you.
Mate, I'm picking up information right now, Tom, I'll be honest. I
I-
don't know why. Like, I'm trying to think from a personal perspective, because I don't consider myself to be a stupid person. But I've never really, I don't know whether there's part of me that doesn't really want to admit that I'm getting older.
Mhm.
Part of me that doesn't want to admit that, that I'm mortal in terms of, I don't mean that thinking I'm a superhero, but I mean, like, nobody wants to think about their death, do they? Or
No.
nobody wants to really, certainly as a young man, I don't think you don't really want to sit there and think. And that was maybe one of the questions I was going to ask you, was because I know between the age of 17 21, I would have had a lot of disposable money. There's no way I'd have talked about a pension, mate, because that was so far.
Yeah.
And maybe that's a trades-based thing.
I think it's an educational thing.
Yeah,
I think it goes back to people who don't talk about money and don't realise.
It was always a problem for tomorrow. If I'm honest with you, Tom, the way that I used to live my life at 17, I was probably quite convinced that I was never going to see pension age. It was like, and I used to, mate, I used to take some silly risks and do some silly things.
Yeah.
And I guess, I didn't really ever look that far, because maybe I thought probably ain't going to get there.
You know the average age of someone in the UK that starts their retirement planning currently?
40.
55.
Really?
Yeah, it was one of the
I've
things.
got loads of time.
And and when I talk about retirement planning, I mean people actually for the first time sitting down, maybe with a financial advisor, and going, right, okay, what's going to happen with my retirement? And the reason for that is I think most people do what I mentioned earlier, and they just put their pension to one side, and whether they're paying to one or not, they don't class it as part of their overall financial plan. And it only dawns on them. I think 55 relates directly to where you can access your pension at 55. So most people now who know they've got a pension will go, I don't know what it's been doing all these years, but I can take some out now. So let's speak to a financial advisor and see what I can do. And it's at that point that most people go, oh, that's all I'm going to get.
Yeah.
That's what it's going to do for me.
Yeah.
And that whole dream of retiring at 55 vanishes in front of their eyes, and they realise they've got another 10 years of working because they haven't really kept on top of it over the years. And if they'd maybe invested it differently, or maybe managed it differently, or maybe just contributed a little bit more over the years, it would have painted a very different picture. And
let's talk figures then, mate, just for illustrative purposes.
Example purposes.
Making me feel terrible. 40-year-old, no pension, no plan.
Yeah.
Realistically, how much would I have to invest into a pension on a monthly basis for it to make enough difference for it to be worthwhile?
Okay. But it's based on personal circumstances. Just
sorry, you were going to give me the example of.
I am, yeah.
If I was sensible as a youngster.
Yeah. I do want to do that.
Let's do this. It's important. Yeah, absolutely.
So if you had been paying, we'll use the example of £200 just to throw a random figure in there that was probably affordable during that time. Yeah. So £200, which would have become £250 with tax relief. For a period of 23 years, I'm just doing some quick maths now, which probably isn't great for a podcast. It's me sitting here with a calculator in silence.
I'll sing a song.
So 23 years, which is 276 contributions it would have made by this point.
It just makes me feel old hearing these figures, mate, to be honest with you.
And let's say an average growth rate of 7% a year. Now, equities have produced much higher returns than that for a long time, but I use that as a conservative growth figure. So this isn't you giving high risk funds. This is you with a very sort of medium risk type return over the years. Okay, so at this current moment, you would probably have somewhere in the region of 160 to 170,000 pounds in your pension pot. But what would happen from this point onwards is that you would have another 10 years of doing that. Okay, so that's where you would have got to. And if you continued to do that, so say you had £160,000 in your pension pot now, based on what you've done for the last 23 years.
And I would assume, is that just keeping it at 200 as well?
Keeping it at
Because
200
obviously
for the next 10 years, yeah.
Income has risen. So arguably, were I sensible, I would have increased that.
Of course, yeah. But this is a
throughout
very
that.
sort of basic example,
Yeah.
just to
Okay,
put some
yeah.
numbers behind the theory.
Yeah.
So even if you had 116 now, you've got 10 years on your side, and it's in the later years that the compound growth effect really works in your favour, because 7% of 160 grand is much higher than 7% of the grand that would have built up over the first short period of time. So 160 grand now, and you had another 10 years, same return, you'd be looking at a pension pot potentially between 800,000 and £1 million when you got to 50. And you're only paying 200 quid a month in, don't forget.
Christ.
In fact, actually, I changed that to monthly deposit 250. Yeah, it would be somewhere in the region of 900 to £1 million that you would be looking at.
What
at
are
50.
You doing to me, man?
And that £1 million,
it's the life you could have had.
Yeah, that would be, in 17 years, because you can't access it at 50.
Yeah.
But what you could have done is thought, well, if I don't earn as much now for the next 7 years till I can get it, it doesn't matter, because all I've got to do is pay my bills and enjoy myself a little bit. Because at 57, what you would then have, even if at 50 you cut your pension down and stop paying into it, because you've cut all your expenses for the next 7 years. Because you're 50 to 57, you've slowed down. So you've taken your 900,000 that you've got to. Again, this is just an example, but these are real figures that could have happened. 900,000 for another 7 years without paying any more into it is
drum roll, please.
About £1.5 million. That £1.5 million, and this is why it's important to start early. That £1.5 million in this example, that is just a numbers in the air example, could have potentially given you conservatively 60 grand a year to live on from 57 without doing anything, and less conservatively double that, 120 grand from the age of 57 without doing anything.
If you're listening to this now and you're 17, speak to Tom about a pension. Joking aside, mate, actually, my lad's come into the business now, so 4th generation, and I feel like this will be a conversation I'll be taking up. Honestly, I'm not even shitting you. Yeah. A conversation probably that I never had, but about exactly this.
Yeah.
To start, because it's all, I guess, when you first start earning a wage, there's that thing of like, oh, this is great. I got my first lot of money, and go and enjoy it.
I can go and load
for a while. But we do, and particularly, I think in the trades, there's a lot of us that are guilty of wasting a lot.
Yeah.
And certainly you don't. I mean, with those kind of figures, it's not a kind of figure that is going to cripple you to the point where you've got no life.
200 quid a month. I think most people in the trade, it may be certainly from the age of, once you've been in a few years and you're earning a reasonable amount, I think it's an amount that most people could probably part with.
But realistically, from 20, I don't, that's maybe at 17 when you're on an apprentice wage, it might seem like a hell of a big chunk. Mm-hmm. But if you've done a few years and you're qualified and you're working, that should be very achievable.
Yeah. And so, and bear in mind, the example I just used, you could have earned much more in growth than that over the recent years because of past performance. Past performance isn't an indication of future performance. We never know what's going to happen. But over the last 150 years, similar patterns have emerged. And that's why people talk about investing as a great way to grow your money.
I know you've shown me the yacht that I could have had. Let's talk about the dinghy that I could get now, eh?
So I suppose, and this is where it would be quite personal to your circumstances, but
I'll be honest with me, mate. I mean, because realistically, I haven't got a bad standard of life. Business is relatively good. As I said, how much would I have to start to contribute to a pension now to make a reasonable difference to my quality of life when I'm older?
When you get to 57. So someone like you who's 40 has got 17 years before they could access funds that earn a pension, which is 204 more opportunities to fund one if you're talking about a monthly contribution to one. If someone was to pay in £600, similar growth rates to what I've just mentioned, relatively conservative way of investing it, you'd land at 57 with maybe £250,000 that would help to support your income and your lifestyle.
£600 a month.
£600 a month. No, that's more like. Let me do the reverse maths on it. £500 to £600. Yeah, £500 after tax relief is £400. So that's on £190. £500, £600. Let me just divide it by 0.8.
Now, listen, that sounds like a lot of money, but to tell you in equation to that, I mean, yes, it is a necessity, but like, for example, the lease on my van, I was quoted, so I've always leased my vans until recently. I bought my last van because of the cost of the lease, but the lease on a new Ford Transit custom van, which was a van that I had before, had gone up. I had my last one on a 5-year deal. I was paying $310.
Yeah.
The quote for exactly the same deal with just a new van, a replacement, was $737 a month. It all comes down to how you frame things as a self-employed person or a business owner.
Yeah.
If you put that in your mind as pension is £600 and it's optional, you're not likely to do it.
No.
You'll find something else to spend it on. If you put it down as a business cost, because that's when I looked at, upgrading equipment or vans or things like that, it's just part of the business.
Yeah.
Like, that is the business cost before I take my living money.
Yeah.
I think then you just got to completely reframe it.
What it is, a lot of people see it as another outgoing, another bill, another mortgage.
Yeah.
When you're talking about £600, and that's talking for someone who wants to achieve something by 57 at 40. So your timeline is dramatically decreased to be able to do the growth. But I try and sort of get people to reframe it as you're just paying future you. And every time you invest, if you look at what that amount that you invest is going to be worth at the end, then actually, if someone said to you, "You give me £600, I'll give you £2,000," you go, "Sound." It's a no-brainer, isn't it? Because there's a 17-year gap between that. There's that detachment from it being that reality.
Yeah.
And when you mention it as a business expense for limited company directors, so the taxation that I've just mentioned, where you get the personal tax relief, when it's a limited company, you can pay it directly from your limited company into your pension, and it's classed as a business expense. It's another way that the government incentivise you.
Okay.
So it reduces your corporation tax bill.
Right.
So it literally is a business expense. It can be a business expense.
Well, let's another direction. So I don't like pensions because I've wanted me 1.5, and now I can only have 250. So, but joking aside, mate. So I don't want to know, when it comes to pensions, are there any other things that we can look at investing in that are going to give us some kind of returns for later life? I mean, the obvious one to go to, mate, is property. So what's your opinion on investing in property?
So there's two different types of property, really, commercial and private. Commercial property used to be included in a lot of investment funds that might sit in a pension, and you can purchase a commercial property in a pension. So not many people realise that. So you can open up a self-invested personal pension, and within that purchase a commercial property, and then the growth that you get has the same sort of tax treatments that you can then protect it from all of the other types of tax that you might ordinarily get from buying a property, selling a property, and getting income from it. So you can do that. But commercial property isn't quite the viable opportunity that it used to be. So if you look at what commercial property is now, it's high street outlets, it's office buildings, it's manufacturing sites, it's factories. And all of those are less profitable than they used to be and less used than they used to be. Everyone works from home, no one goes to the high street.
Here's a prime example. There's a reason why I am sat in a high street recording studio, and that reason is because this unit, which is considerably bigger than the serviced offices I was looking at, was half the price. And how mad
mental.
That? And it's because, I mean, the small town that we live in is a lovely little town, Stourport-on-Severn, anyone want to check it out. But the high street's dying. It is dying. There's all the main branded shops have left. I think there's a couple of, there's like a Superdrug and a couple of other. Yeah, exactly, those places. And then it's like charity shops, barbers, and now a podcast studio. But it was, when I looked at it, this place was just more than half of what the cost of a serviced office would have been for just that frontage in floor space. I think I've got about 560 square foot here. And for about mate, I think it was about 280 square feet. It was nearly double what I'm paying for this.
Yeah.
Which is mad, because when I saw this place come up, my initial impression was there's no way I could afford it because it's bound to be thousands. But I was really surprised by the value of it because it's on the high street.
Mental.
But that, I would imagine, to my landlord, who funnily enough is a financial advisor.
Oh, really?
Yeah. It's a company upstairs.
Oh, okay.
That has got to translate negatively to the owner of the building, but then he operates from the building himself, so
Yeah.
it must be okay. But
Yeah.
if you were to buy this,
you've got to ask as a financial advisor whether he'd own this premises if he didn't use it himself for his office, as if he, from a commercial opportunity. But the answer would probably be no, based on what you make and the margins that are there. So that's the first thing. Commercial property is just not the investment that it used to be. It doesn't have the same, constant yield of income from letting it out or whatever. It doesn't have the same growth in terms of the value of it because of what we've just talked about. The value of this property would be almost diminishing over time because it's less.
Kind of sad, really, that,
less
because I
desirable than it
think
used to
that
be.
says everything about where the country's at in terms of that, the community, the high street, the retail, manufacturing is virtually nil in the UK now. So, and the outlets, everything's sold online. The giants of Amazon have come and killed a lot of shops off.
Yeah. Supermarkets have killed all the independent grocers,
kind of sad,
stores and stuff.
Really.
It is, and it must have been. I don't think I've ever really lived through the period of time where that was the case, but I think maybe the generation before mine would have had that. And I think it would have been really nice, actually. You know what I mean? On a Saturday, go down to the local butchers and into the and all that kind of stuff.
There's a lot of things that resonate, Tom, and it to me, the way I see it is a very quick sort of like summary. I see that the society we live in now, and whether this is, because I've got a couple of opinions on it. Obviously, things are expensive, but we've also got a lot more things. So what I mean by that is, if you took the clocks back, I don't know, say the 70s, right? If you were a working man born in the 70s, when you go home, what have you got to pay for? Because you haven't got massive 50-inch tellies in each room. You haven't got a smartphone in each hand, phone contracts. All the modern technology conveniences that we now have didn't exist, but they all come with a package. Like in my house, mate, we've got a Netflix subscription, an Amazon subscription, a Sky subscription. We've got all these subscriptions.
Disney Plus you might have as well.
Yeah,
they're just
everything
popping up all the time.
And there's laptops, there's tablets, there's all this technology which we all love and have to have is taking a massive chunk of our money. But we see it as an essential now. So it's like people talk about the cost of living, but how much of it is actually living and how much of it is new technology?
Yeah, that we've now decided is essential, effectively.
So I look back and I think, well, a bloke going home or a lady going home in their 70s, in the 70s, would have walked in and thought, I haven't got loads to spend my money on now, which would have translated as probably didn't have to work as hard because I wouldn't have had to have earned as much, which then translate back to what you said very early on, time. So they had more time to then go to the butcher, the baker, three different shops, wasn't it? It was like you were going to the butchers, you were going to the bakers, you were going to the greengrocers, but then you've got the community spirit. You're going to meet people, you're going to see those people, you get that personal relationship. Pubs were busier, better quality, and arguably, better quality food in the butchers. I haven't got all the additives and that quality of life that we see as improving. I'd argue against it in a lot of cases.
Yeah, absolutely, I agree. Let's get back to your question.
Gone real deep there, mate. Just talking about the high street.
Yourself back in the day being in the grocers.
Honestly, I think stick me in the 50s in a lot of ways.
I think they were happier. I do think they were happier times.
Yeah.
Because they were simpler times and
bang, nail on head.
Being
simpler
simple
times
is actually really good for us, I think, and stripping life back to simplicity.
Giving us that time back, and I think that's one of the things it all plays into each other, because the thought now, if I thought to myself, I barely have time to go to the supermarket, and then a lot of people will order their shopping online.
I do.
There you go. So it's delivered to you. You don't have to go anywhere. But the thought of going, oh, right, okay, I've got to go to 4 or 5 different shops.
You think, I can't be bothered to do it, or I haven't got time to do these.
I've mentioned this one before as well. I've seen the change in my customer demographic. So when I first started, in construction, in the trade as a decorator, I would work for a lot of customers where, generally speaking, there's no sexism here, but stereotypically, the man was at work and there were a lot of housewives that we work for. That has changed so drastically now. I would say 90% of my customers are dual working couples, husband and wife, whether there's kids or not, both at work full time. And then I look back and I think, well, how was it that the average person could survive in a household on one wage? And it wasn't that my customers back then were like CEO of Microsoft, you know what I mean? Like
everyday jobs,
normal people, not even necessarily management role. I mean, we're talking some would have been going to work at, factory workers, manufacturers, things like that, and middle management, or not even there, but relatively comfortably sustaining a household. I don't think that's possible now.
No, not unless one of the owners is significantly high earner.
Yeah.
That's the only way that it's really possible.
And
or you accept a very, again, going back to you need money to live in the world that we're in now, accepting a considerably lower standard of living. That's the other way of doing it, isn't it?
Yeah. And it then comes full circle back round to, but is it the stuff that we deem as essential, is it really essential? Or are we told it's essential?
Well, we've definitely marketed into a position where believing that it is, aren't we? That's for certain. There's a lot that we can say that we benefit from the modern way of living, but there is definitely that taking away the simplicity that they're probably. And I've never experienced it, so I can't. It would be nice to compare, wouldn't it? Imagine being able to go back and just live it for a bit and go.
I think I was on the cusp. Mate. When I grew up, I think I'm trying to think. My first mobile phone, I was how old are you, Tom?
35.
Okay, so we're not that far apart.
No.
My first mobile phone, though, probably significantly, was probably 15, 16, maybe. And it would have been old school, like it had Snake on, or whatever. It wasn't a smartphone.
Yeah.
So prior to that generation of no phones, no cameras, life was so much simpler. It really was. No social media. And look, you've only got to listen. Anyone listening to this now, open up your smartphone and check your screen time. Challenger.
It's disgusting. Mine is disgusting.
Because
I use my phone a lot for work, so that's my excuse.
Yeah.
But the truth is, I don't use it that much for work. I don't use it the amount of hours that I do. My missus gives me a right hard time about it. She's always saying,
we all do.
On your phone.
Listen, it's in society now. It is what it is. But you check your screen time, and what the point I'm making is 20 years ago, 30 years ago, that time would have not. You wouldn't have been able to have screen time because the screen weren't there.
Yeah.
So you would have then had, arguably, those 4, 6, 8, 16 hours to do other things.
Just build relationships with your family more than anything else. You know what I mean? Actually speak to the people in the room rather than just sit there on your phone.
Exactly. It's frightening. Anyway, so not commercial properties.
In a really long roundabout way, commercial properties probably not the way to go. And then you've got private property. So there's a problem with that in the UK as well. There's not enough properties available for people to buy, and it's causing a problem. So if you look at the ratio between the average earnings and the average house price, it's creeping further and further apart.
Yeah.
The average first-time buyer in the UK now is around about 32 years old. I find that mental. I mean, I was 25 when I bought my first house, and I almost felt it was a little bit late, to be fair. I felt like I could have done it sooner. There's no right time. The right time is when you're really comfortable to do it, in truth. But that age is creeping up and up and up. And there's not as many houses available to purchase. And the reason for that was there was a long period of time where buying up private property was seen as a really good investment method. And it came with a lot of tax advantages. You could, write off tax from the income that you got from it and all of that kind of stuff. And it was almost as if the government was encouraging people to buy to then become landlords, then rent it out. And then that happened on scale to the point where there's too many landlords now and too many properties being owned, and there's not enough houses to buy, and it's creating that problem of people buying later and people not being able to afford to buy their own place. And so, for that reason, it's not necessarily that there were tax breaks, but there's taxation at every single point that you buy a property now. So, if you buy a second property, there's additional stamp duty to buying the one that you own. So, you've got stamp duty rates that kick in from £125,000, kicks in from naught when you buy your second property, and
Okay.
it can cost thousands and thousands of pounds upfront because you can't put that cost off. You've got to pay it upfront. So that's the first part that you get taxed on. The next part that you get taxed on is the income that you get from it. So it's only the interest that you can write off as a business expense. The rest of it is income that then gets income taxed or taxed from within your business if you do it in a business. So along the way, you're getting taxed on it. And then over time, the property will go up in value. And then you'll come to sell it at some point in the future and make all of those years of having it and owning it and all that kind of stuff, and the costs involved and the tax that you paid over that period of time. You then come to sell it, and there's capital gains tax at the end as well, which is up to 24% that you would have of the amount that you've made. So every stage of owning a property, it's taxed, and it's like that because the government are trying to disincentivise people from becoming landlords. They would prefer the properties to be on the market, and it's that amount of taxation that you experience at every stage of owning a property that makes it a less viable option than it used to be. Don't get me wrong, properties still go up in value 2 or 3% a year every year. That just happens. It always has, always will. So if you're willing to play a very long-term game with it and accept that you're going to not make much money from it during the course of owning it because the profit margins have been squeezed by interest rates are higher, so you pay more for the buy-to-let mortgage. Then you get taxed on the amount that you make, and it's been squeezed as a profit maker along the way.
Yeah.
Then you've got the costs of being a landlord. Your tenants will say, "Oh, the boiler's broke, or this door's broken, or whatever it might be." And unless you're someone in the trades where you can go and fix it yourself. If I owned a property, it would cost me a fortune because I have to pick the phone up every time something like that happens. So unless you're willing to absolutely play the long game and just go, right, I'm treating it as someone else is paying the mortgage off and I'm just going to have the property at the end and I'm willing to pay the tax along the way and at the point that I come to sell it, then it can be still a very viable option. I'm biased because of the world that I'm in. My go-to way of investing is by utilising equities. That's what I advise people to do. I've seen the growth. I've seen what people have achieved through using that as a
So we're
method
talking
of
stocks
investing.
and shares, equities and businesses.
Yes, that's it.
Okay.
So for me, when I look at that, compare buying a property with all of the taxation I've just mentioned as your long-term plan and go, I'll just sell my properties when I come to retire, or use the rental income, to a pension that you just pay into each month and the ease of that and the tax relief. I'm going, which one would I rather do?
Oh, mate, I'll be honest with you. I think you've sold me a pension today. You've made it sound quite appealing.
It's incentivised by the government, so they want you to pay into pensions. They don't want you to own properties.
Right.
And all of the landlords that I meet with a lot of people who are quite affluent and own property because that was the way it used to be.
Yeah.
I haven't met a landlord yet that isn't selling the property because they just can't be bothered with it anymore. It's not the option that it used to be. Yeah, they've said, I've made a bit of money on it, but I'm just going to get rid now. And literally every single time I speak to a landlord, that's the sort of frame of mind that they're in. It is and can be a long-term viable option, but you have to accept that it's not going to be quite what it used to be along the way.
Is there anything else, Tom, like that you do? So, because we're only talking long terms here, but pensions, obviously you're a big advocate.
Yeah.
Property, not so much. Is there anything else?
So you can still invest in the way that I mentioned. So utilising an investment fund that you put your money into via different types of wrappers. So a stocks and shares ISA. So most people in the UK who own an ISA, for anyone who's watching who doesn't know what an ISA is, it's a savings account effectively that you don't pay any tax on the interest or growth that you make. So I mentioned earlier, if you've got money in a savings account and you make more than £1,000 a year, then everything on top of that is deemed as income and you get income taxed on it. When it's in an ISA, you get £20,000 a year you can pay into it, and you can build that up over the years. Most people think that 20,000 is the max you can hold. You can pay £20,000 every time that the new tax year rolls round, and you can build it up and have an endless amount in there over the years if you do it. And so all of the money that's in your ISA is then interest or growth that comes from it. You keep all of it. There's no income tax on it. So you can invest in an ISA that's a stocks and shares ISA. Most people hold cash at the moment, but 80% of people who have an ISA have it in cash. So it's just like a savings account with tax-free interest. But you can have an ISA that you then invest in an investment fund managed by fund managers who do all the work for you alongside it, or in a passive fund that just tracks an index. And that's a shorter term version of investing. There's no minimum age to access it. You could have invested, say for example, investing in a stocks and shares ISA, you would have achieved the similar levels of growth over the last 23 years, and you could get to it at 50. You wouldn't have got the tax relief along the way. It wouldn't be as big in terms of the pot size because you haven't had the tax relief topping up how much you've made. But it's an investment vehicle that you can use where if you've got spare money, either as a lump sum or either as a regular amount of your income that's totally spare, then you can invest using that for 5 to 10 years rather than the long run.
Okay. I've got to ask you this, mate, because I wouldn't be doing my job as a host if I didn't when I got a financial bloke in front of me.
Go on.
What do you think about crypto?
Again, I'm biased on crypto. I like to give a balanced argument because crypto has grown exponentially at a rate which is just incredible since its inception. If you'd invested in Bitcoin about 15 years ago,
yeah, phenomenal.
You could buy a Bitcoin for about $1.
Yeah.
They know, I haven't checked the price recently. I don't track crypto because it's not my thing, but not that long ago, it was about $100,000.
It's over 100,000. Yeah. I think the first thing ever bought with Bitcoin was a pizza, wasn't it? And somebody paid something like 10,000 Bitcoin for a pizza, which today's day and age would be
just ridiculous.
Yeah, insane. But it's I've got to ask because I know, and maybe again in construction, maybe it's a high risk element to it. People are a bit more switched onto that. People dabble.
Yeah.
And don't get me wrong, mate. I've known people make good money, and I've known people lose money. But yeah, just to get your take on it, really.
So my take is that when I look at crypto as an investment vehicle, as a choice for trying to make your money grow over the years, what we haven't got with crypto is much track record. It was about 2010-ish, 2011, 2009, actually. It's somewhere in that ballpark, 15, 16 years ago that it became a thing and people started investing in it. So we've got about 15 years of data on it, and we've seen what's happened in those 50 years. If that repeats itself, then everyone should be going and investing in crypto now because, it would be brilliant. But we don't know. It's not regulated. There's something that's called rug pulling that happens within crypto where new coins are launched and then, the people who have heavy investment amounts in it then draw all of their investment out and everyone else who invested just loses a lot of money. And
that is so I know a bit about crypto. That is very common.
Yeah, ridiculously common.
It's bizarre. I mean, the whole... Do you know a lot about crypto?
I know enough to understand it. I wouldn't call myself an expert. I don't think
many people are. But the rise of like these meme coins that have no intrinsic value, and it is just it's a blatant. It's there for you to see. It's a pyramid scheme. It's people paying into something, and it is like playing Russian roulette with your money. Yeah. It's like, well, I'll pay in now in the hope that more people will pay in, so my pot will go up.
Right time.
Yeah, exactly. But in reality, it's the people that have, those behind the scenes.
Those who launch the coin are often the ones doing that.
Exactly, 100%.
It happened with that. I spoke about this on a previous podcast, and I find it embarrassing. So, but Hook Tour.
Yeah, I do, mate. Yeah. The Hooked girl.
Yeah. She launched a coin. Did you see what happened with that?
Yeah. So, hasn't she been banged up now, or she's been arrested for it, or she's going to get arrested for it?
She's definitely been sued, even if she's not been arrested.
I'm pretty sure, because I know in America there was a big crackdown on crypto. The FCA really don't like it. And yeah, I'm pretty sure that whatever state she did it in, it is illegal.
Right.
And I'm sure she was definitely arrested. I don't know about the whole charge and prosecution
I didn't follow it beyond the point of seeing that it was one of the quickest turnarounds from a coin being launched and then being rug pulled, where it was like 20 minutes. And because of its fast growth and the whatever price it launched at and then finished up at after 20 minutes was ridiculous. People were investing in tens, hundreds of thousands.
She said she didn't know that she couldn't do that.
It's open to that. I think it can be too easily manipulated by people in positions of power, either those who are invested in it. You've seen things happen in America where, I'm sure there was a time where Elon Musk came out against one of the coins and overnight it lost half of its value. It might have been Bitcoin. I can't remember what it was. Like I said,
so Elon Musk was involved in that. It's a weird thing. I'm pretend to be fully clued up, but he backed the whole Doge coin, which, funnily enough, now this whole investigation in America, there's a
Yeah,
Doge department.
Department of Government Efficiency.
Yeah, I heard him on a podcast on Joe Rogan the other day. He was like, "Oh, what a coincidence!" So yeah, he was kind of weirdly wrapped up in it, and yeah, Elon has this strange power where he's only got to mention the word Bitcoin, and it will.
Yeah.
You know,
And to me, I find that scary. How volatile that is as an investment. I'm in the world of utilising real worldwide economy to people's benefit with 150 years of data, knowing that you're investing in real things that real people are using, that are regulated, that there's rules around, that you are protected if something goes wrong. I much prefer operating in that space than in a deregulated one that can be manipulated and rug pulled. But the only caveat to that being, I know what's happened with Bitcoin over the last 15, 16 years. And if that was to happen again, I would look like an idiot for sitting here and saying, don't invest in crypto.
Probably the key message, I think, to anyone who is looking at investing in crypto is to understand the difference between the main cryptocurrencies. To name a few, you've got Bitcoin, then you've got Ethereum. Beyond that, there's like Solar. There's a few, maybe top 10, top 20 coins that are more heavily, I guess, I wouldn't say that it's not regulated, but there's a lot of...
I think there's more people invested in them, so there's lesser movement in it. That's what it is.
Well, Bitcoin, it's a funny thing. I mean, again, I don't know the ins and outs, but there's a system where it automatically halves itself every so long. So what you invest in is bound to become more valuable as time goes on because there's a limited supply and all that kind of thing. I think if you were going to invest in crypto, the main two, Ethereum and Bitcoin, were the ones with the least risk of the rug pull that you mentioned.
Yeah.
But there are these sort of other coins that come up, the meme coins or the pop-up coins that tend to... I mean, like there was a Trump coin, wasn't there, launched the other day, and it's got no intrinsic value. It is literally a pyramid scheme. But you just got to know that the developers of those coins are these tech wizards that will launch a coin at a value of, say, $1, having given themselves $1 million at the value of 0.0001 of $1. So they're sat there, and immediately, as soon as the coin goes live, they have like not even market dominance. It's like they have like 99% share of what you're just giving them your money. Is what you're doing.
Yeah.
There are people that have made money on these, the meme coins and the what they refer to as the shit coins. And I know people that have made big money and getting in and out on the right time, but it is literally like Russian roulette.
Yeah,
is with your money. If you're going to do it, my advice would be it's like going to Vegas and sticking your disposable money on red. Like, it's a gamble. That is truly what it is. It is a gamble. It's not a stable investment, which is what you talk about. With the exception of the main ones like Bitcoin and Ethereum, and they still fluctuate massively.
Yeah.
But yeah, it's
the way that I would compare it in closest terms to like traditional investing. So investing in company shares, investing in Bitcoin is like going, okay, it's big, it's well established, it should grow over time. I'm going to invest in Google and just buy only Google shares. But then what you're doing is you're giving your money exposure to one thing and one thing only. And if the shit hits the fan in some way, shape or form with one of those two things, people go, oh, well, Google will never struggle or go, lose value.
Yeah.
But something could come along. I'm sure there was something recently about Google being apparently looked at by the Monopolies Commission, and they're too big and blah, blah, blah. It only takes something like that for a really stable-looking investment to all of a sudden go backwards. Different pressures on Bitcoin, but you're choosing one thing and putting all your hopes on it. And I would never encourage people to invest in that way. I look at investing in diversifying your money around the world, so when one economy is doing better than the other, it's holding the other one up. When what a fund would also have is companies that offset each other. So it wouldn't be in there, but this is the example that I use, like an umbrella salesman and an ice cream man. So when one's making money in the rain, the other one's not. And when the sun's shining, the other one is. And so you'd have this diversified fund made up of thousands of companies.
Okay.
That means that your growth does still do that, but it's much less volatile than just choosing one thing to invest in. And that's what Bitcoin or any of the other coins are, you're choosing one thing and you're hanging your hat on it. And if you do that with money that isn't just disposable and you're willing to lose, then you're taking a big risk. So it's about diversifying.
Solid advice, mate. Solid advice. I mean, I'll tell you at the end anyway, as such. But for anyone that does want to get in touch with you, how do they do so?
So I'm on Instagram. I'm on all the different social sites, but I'll give you my Instagram, which is Sawbridge Financial Planning. Got a website as well that you can have a look at, sawbridgefp.co.uk. And you'll see all of the videos that I post regularly. I try and post regular useful information all of the time on social media, because what I see on social media is a lot of people talking about investing, but they're not regulated advisors. They're just people who have done all right for themselves in investing and just started taking it upon themselves to start giving advice to people online. And that's quite dangerous sometimes, because you could watch one video and go, oh, I'll just start doing that then. I'll invest in that particular fund. And it could be the wrong risk profile. It could be not wrapped in the right investment wrapper for your circumstances. So I try and push out regular information. So even if you just follow me, just to try and see if you can get some sort of tips that match your circumstances along the lines of the things that I talk about and help people with.
Tom's details will be below. Wherever you're watching or listening to this, scroll down. It'll be in the episode description. So do go and give Tom a follow. But I'm assuming anyone that's listening, if they wanted to start that process now, they've listened to what you've said and they've thought, I need a bit of advice here, they can reach out.
Of course. Yeah.
So, because that was going to be my next question is, for the average person that's like me, bumbling their way through life, kind of knowing a little bit about being in the construction industry, I wouldn't necessarily know where to start when it comes to stocks, shares, investing, what platform or method of doing it.
Yeah.
How does the whole process work, mate? If you've got a fund manager, asset manager, how does it work?
So if you do it on an advised route, well, you can do it either way. But if you go down an advised route, what happens is you sit with an advisor and they say, okay, what are you trying to achieve? How old are you? When do you want to retire? Have you got anything along the way that you want to achieve with your money? How much spare have you got? What do your finances look like, etc.? Have a good chat around what's important to you, your financial plan, and compare the two. What the financial advisor will then go is, well, here's what you should invest in, here's the wrapper that you should use, and this is what it might do for you at this point in your life. So it simplifies the whole thing for you. It takes it from funds, investments, platforms, and just simplifies it into, here's what you should do, and this is what it'll do for you, and this is how much you might have to live on when you get to whatever point it is. Which, to be honest, when it comes to investing, that's what you're really trying to achieve. At what point can I use this investment to supplement my lifestyle, and how much will it give me? And that's what advice sort of does for you. If you're doing it for yourself, which you absolutely can, say, for example, you wanted to start a pension, you could go to one of the various different platforms online. I won't mention them because I'm not an advocate or I'm not associated with them, but you can find it for yourself. You'll know the ones that are there. I will stuff it. Trading 212, Pension B, the Hargreaves Lansdanes, all of these types of platforms. And then you can choose, if you're looking for diversified investments, you want to look for something that has a spread of thousands of companies, and you can sort of figure this out for yourself. And there's two different types of investment, an actively managed one or a passively managed one. The difference between the two is a passively managed one doesn't have a fund manager choosing where it's invested. It tracks an index. It might be the S&P 500, where the top 500 companies in America, your money is spread between those, and whatever they make, your money makes.
Okay.
If it's an actively managed fund, and you'll see when you're looking at them what they are, then it's a fund manager who's taking your money and spreading it around into different companies and changing where it's invested over time to make sure that you get the best returns. Doesn't always work out that way. Sometimes they passively outperform actively managed. My personal preference is actively managed ones, though, because that's someone, it's not one person, but it's a firm that's managing your money and investing it around. So you would choose a platform. There would be a fee for the platform management. There would be a fee for the fund managers. There might be an additional fee. If you do it on an advised basis, there might be an additional fee that's built in. And so you look at it, you see what the fees that you pay each year, you can look back at the previous returns, and then you just start investing in it. So it's not as complex as it really needs to be honest. If you want to absolutely get it right, seek advice. It's not an advert for me. This is an advert for advice.
Well, I think it's a really good idea, genuinely. And listen, this is not a sponsored episode. Tom's not paying me to say this, but just sitting and listening to you for a bit, it makes all the sense in the world to me. particularly for the construction industry, because there's people out there making good money now.
Yeah.
There's a skills shortage in the construction industry, so demand dictates value. I would imagine that the value of the industry is going to rise over the next few years, and when that comes to wages, which then translates into disposable income,
Yeah.
And short of going on extra holidays and stuff like that, we do have to start looking at our future.
Absolutely.
And particularly with the hard nature of the industry, what you said has made a lot of sense, in fairness.
Yeah.
Um,
The other thing that I was
yeah.
going to say in relation to people in the trade, because there's two aspects really that I think are the most important. So you've got planning for the future, because you've got probably a more time limited sort of process that you're going to go through than most people. But also, you've got a higher risk of injury than probably most as well. So, me, in what I do, I sit either in my office at home at my laptop or on someone's sofa with my laptop. The chances of injury are pretty slim. I'd have to be quite unlucky to really injure myself doing my job. People in the trade are contorting themselves, stretching, using their bodies in a much more active way. So there's looking to the future, but there's also protecting the now. Most people who are in the trade, or a lot of the people who are in the trade, are self-employed. Being self-employed means you've got no sick pay. No sick pay and a higher chance of being injured is a really bad concoction for you being thrown off track if something happens along the way. Not many people realise that they can just put their own sick pay in place. It's called income protection. And you can pay a monthly premium, which is often less than people think it's going to be, that will provide you with a year's worth of income if you're off work. And so those are the two things really: planning for the future and then keeping yourself on track with a bit of protection, so that if you do injure yourself at some point or you fall ill, there's not just injuring yourself, there's, you could be diagnosed with something serious that keeps you out of work for a year or two. Protecting your income along the way as well. Most people are willing to give up 60 quid a month for an iPhone. But when I mention 40 quid a month for making sure they won't be out of pay if they're off work for 6 months, they go, oh.
Mate, you're not wrong, Tom. I mean, I had this whole battle with myself over like private medical cover, which I've got, and again, I had to justify it to myself, my own brain, as a business expense because of the whole. We insure our vans, we insure our tools, we insure our business.
Yep.
But if you don't insure yourself, none of that matters.
Yeah.
And that was how I came to that conclusion. So it's the same thing, really. You see it as a business expense.
Yeah.
It's part of the cost of running a business.
And if you're a limited company, it literally is. If you can set up an executive income protection, which is owned by the business and pays out to the business, which is a deductible expense for your company as well. So you save corporation tax on the cost of it. And so having those two things in place, a proper retirement plan by utilising a pension, some income protection that means if you're out of work for any period of time, you're covered and you've still got some income coming in, means that you're much more financially bulletproof looking to the future than you would have been before. Because it's all right having as many grand plans, whether that's investing or otherwise, for the future, but if being out of work for 6 months is going to use up all your savings, then you're really exposed.
I think it would probably be quite shocking and frightening, really, to see just how many people do live, job to job, paycheck to paycheck, and that small derailment, mate, it can absolutely destroy people.
Yeah.
And you're right. It can quite often be a nasty circle, nasty cycle as well, because sometimes when you're under financial pressure, you're more likely to take risks, which then are more likely to lead to injuries because you're trying to get that job done, or you're trying to finish that job a little bit quicker because you need to get on to the next one because you need to bring some more money in. And then as a consequence of doing all those things, putting yourself under that pressure, you then end up with the injury or the accident that then actually derails you further than where you were in the first place.
Yeah, I think the question to ask, I mean, if anyone's listening to this, think about, if you haven't got any protection in place for your income, if something happens, how much is in your savings account, your savings account now? And think about how much you pay yourself on a monthly basis or how much you earn. How many months would you last before you're out of money? For a lot of people, that's quite a scary thought. I think I saw a stat the other day. I think about 50% of people in the UK have got less than £1,000 in savings, and something like it's around about 20-25% have got less than £100. And so that's a large proportion of people that are very vulnerable from a financial perspective if, for whatever reason, they're off work. It works for employed people as well, not just self-employed people in the trade, where how long would your sick pay be there for, and would you be comfortable for beyond the 3 months that you get or the 6 months that you get? It's one of the most important things to have in place if you're in the trade, is something that if you do injure yourself or you do get sick, that replaces your income while you off for whatever period of time that it is. Because if you say, for example, you became injured or ill and you're pushing yourself to get back to work, you might actually go back before you should have done. You haven't given yourself time to heal or get better, and you just prolong the issue and create a bigger problem. Whereas if you had something that you go, okay, well, I can take the time to heal, I can take 7 months off work, or 3 months because I broke my arm or fractured something, or
Do you know what, Tom?
something.
It all plays into the whole mental health picture as well, of the pressures. I mean, over my time at work, I've done it so many times, mate. And even, Christ, 3-4 weeks ago, I picked up a bug. I was really ill, mate, and I wasn't doing. It wasn't out of money pressure; it was out of time pressure. Really ill. Customer was on holiday, so I had no risk of taking it to them. But that was part of the pressure. They were coming back off holiday.
You needed to get done before they were back.
Absolutely. We'd had a job run over. I'd got a 4-week slot to do this job. It was initially booked in that I'd do the work on the second week they were away. Ended up being right at the end. So they were coming back on the Monday, and I was due to finish on the Friday, and on the Tuesday night I was up all night. Real horrible bug. Wednesday I was in work. Thursday I was in work. Friday I was in work, and I felt terrible. But going back, my younger years, I came off a ladder, broke my hand. I was still in work the next day. Working for a period of whatever it was, 8 to 12 weeks while that recovered. No time off. And there's so many. Listen, I'm not trying to play the hero badge here. That there's a lot of people in construction that will resonate
100%.
with that. It's not always money. Like I say, it can be time pressures, job pressures, but ultimately it always translates to money. Because my customer, they're good customers. Realistically, a lot of it sits with me. I probably could have.
If you'd have said, I'm really ill, they'd have gone, don't worry about it.
I probably could have turned up Monday once they were back and be like, look, I'm really sorry. I've been ill. I didn't manage to get it finished while you were away. But there's that part of me that wants to protect my business and reputation. I didn't want to let them down. Ironically, they were in Australia, and I found out because the daughter-in-law rung me that they were caught up in a cyclone and didn't get back till Wednesday. So
you could have let yourself get better.
I actually could have had a day or two in bed. But there you go. I couldn't have predicted that one. But and that plays into the whole spiral when it comes to mental health, of the pressure and having to go to work when you're ill, having to work through the injury, the bad back, the broken arm, the twisted ankle.
And you know what else income protection covers you for? Mental health. So if you are signed off by a doctor as unfit to work because of some sort of mental health issue that you have, income protection will pay you out. So imagine you're really struggling, and whatever it is that you're struggling with is really starting to get in the way of you being able to do your job to the level that you want to do it. Or you just need some time to be able to, breathe and take some time out of work. How many lads are still pushing themselves through and continuing to work when they're really, really struggling? If they had income protection in place, they could present a doctor's note to the insurer and they could take a few months off to get themselves right, and their income would still be there being paid to them. From a perspective of that protection, and let's face it, many more people struggle with mental health than we still even realise now. And many more people, I think probably going to work with a broken hand is, equally as damaging as going to work when you're really suffering from a mental health perspective, from the chance of it having repercussions in the future.
One plays into the other.
Exactly.
I've done, and again, it's not like I'm trying to wear the hero cape, but I've done so many. I've been negligent of my own personal and physical health because I've had to get back to work, and I remember I broke my other hand, and I can't actually fully straighten my little finger on my right hand because I never got it fixed on it because I was straight back into work. I didn't. When I broke my left hand, same thing. I remember going to the hospital, and I didn't even go to hospital initially. I went to work the next day and realised that I couldn't hold a paint tin. And it was early days. Do you know what? I'll be honest here. There's a story. I was only 18. I'd not long took over the business. I was still working with my grandfather. He'd gone home early. We were doing an exterior. It had rained. I pitched an angle on the ladder, a stupid angle. Ladder slipped. I went down on top of it, crushed and broke my left hand. I was too embarrassed to tell him. Right, I didn't want to admit that I'd fell off the ladder. Nobody saw it, and I hit all my ribs. There was I was in this courtyard, and there was an old fridge. I bounced off that, hurt all my ribs. They were okay. It was just bruised. But yeah, I remember I didn't want to tell anyone. And I came to work the next day, and it was my granddad at the time. He clocked me I couldn't hold the paint scuttle in my hand because I just had no grip strength in my fingers. Just, what's going on? My hand was all swollen. I fell off the ladder. It's like, you can't hold that now. Right, off down the hospital and got it scanned, broken. And again, we'd got a job on, and we'd rented some equipment that had to be used. And the doctor went, we'll have to put it in a cast. I went, can't do it, mate. And he was like, for the best chance of healing. And I ended up conceding to this like weird glove thing with a metal rod up it. They wanted to put it in a cast. I refused the cast. I ended up with this other thing on for about 8 weeks, which after 8 weeks of working it was rank. But yeah, I did that. I went to work after breaking the other one. Like I say, my fingers never hit. I've done all these things. And I say that because there'll be so many people listening now that will be like, I did that. I did this. I did that. I did the other. Yeah. Problem is, we wear it as a badge of honour. I probably did. There was years gone by where I've probably sat there and gone, oh, well, I went to work with this.
I was still on site.
Yeah, 100%, mate. But it don't bode well because it puts that out there that what's expected. I was conscious of it with my son the other week because he saw me go to work really ill. And he was like, as if you're going to work. And I was like, mate, I've got no choice. But to try to do that in front of him and then not put that expectation on him at the same time is quite a difficult balance to achieve. But I think, long-winded way, but having that the protection in place that you talked about, it would, I think, take that pressure off for a lot of people.
Yes. If you knew you were still going to have some income, if you needed to take some time off. Some people would still go to work because that's just the way that some people are.
Yeah.
But many more people would take the time that they need to heal, physically or mentally, if they needed that time out of work.
There's so many times, mate, I'll be honest, where I've muttered the words, if only I wasn't self-employed. Honestly, like in those, whether it's illness or injury, and I've thought, I could name so many, actually. I'm sat here now thinking about all the... I remember I tore the medial ligament in my knee, tore the meniscus playing football, still went to work. I couldn't walk. I had lads working for me. I sat on a chair pointing at things. I've done my back in. So many things, mate. I look back over the years now.
Yeah, you're going, if only I wasn't self-employed. But it doesn't need to be that way. You can, if you take a small business expense to make sure that you're protected if something happens, then you'll never be going, if only I wasn't self-employed. You'll be thinking, I'll just take the time to recover and I'll get back to work.
Glad I listened to Tom. Is what I'll be thinking. I mean, on that note, actually, for the personal injury protection, is there anyone you'd recommend in terms of like, I don't know how it works, mate. Is it like
financial advisors can help you with that? So if you wanted to have it in place, a financial advisor, I cover people from now and making sure they're okay day to day to the future and everything in between. So if you can search for income protection on Google and you'll find policies that you can just set up for yourself. You'll be able to figure out how it works. If you want to get it right based on your own circumstances, so you've got the right value point, and get some advice.
Simple as.
And then the advisor will guide you on how to set it.
I mean, I guess the only other question that I think I need to ask just for clarity, because there'll be people thinking it, is using a financial advisor. How do you make your money? Or is that, do you charge a fee? Is it a monthly thing? Is it
because of FCA rules, and this is going to sound like me trying to avoid the question. Because of FCA rules,
I'm not trying to avoid the question, Tom?
No, I'm not allowed to talk specifically about the amount that I charge in the public domain until I've sat down with someone. No, but
I wouldn't be asking for a fee.
But the way that it works, generally speaking, there's two different ways that financial advisors work. Some will charge you based on their time or the type of work that they're doing for you and how sort of like a day rate in a trade, effectively. How long is it going to take to put together? And they'll charge you a fee for that. Others will make money from commission, from selling policies, from having ongoing advice fees built into the fees for the pension, etc., so that it often doesn't create a direct upfront cost.
Okay.
What I would say is one of the first questions that I always get asked is, how much do you charge for an initial chat? It's clearly it's on people's minds, because people go, I'd like to get some advice, but if it's going to cost me a fortune, I don't really want to do that. Almost every financial advisor will charge you $0 for an initial chat to see whether it's worth working with them, and me included. So if you wanted to reach out to an advisor, what I would say, generally speaking, find someone who you think you can resonate with, because you need someone as a financial advisor who gets you, who's on your wavelength and can understand your perspective, to be able to get yours and their perspective in line to guide you on what you should do in the future. Find someone who you like, agree with, that you trust, either that you already know or that you have researched and looked up, and speak to them and say, how much does it cost for an initial chat? Most of them will say nothing. And from there, you can figure out what the value of working with them is, whether the charges are too much for you, and whether it's worth working with them long term. What I would say, generally speaking, is most people wouldn't use a financial advisor if you didn't make significantly more than what you pay for the service. It's like anything, it's going to cost you more than doing it yourself. If I wanted to build a new porch on the front of my house, I could probably research it to the point where I could do it myself, but I'd rather pay a builder and have it done properly. If I wanted to get my finances right, and this is where a lot of people don't sort of think about it like this, I'd rather pay someone to help me get it absolutely right and know I'm using the right way of getting it done.
You're a professional in the industry, and I'll refer back to what you said initially, which is time. My personal perspective on using people that are professionals is, I would rather pay you for your time so I can use my time to do what I'm a professional at and earn money over there. So while it might take me hours, days, whatever, dealing with all these various elements that I don't really know how they fit together, I would rather just go, do you know what, how much does it cost? Okay, I'll pay you to do that, and I can now go off and do this other thing where I can generate some income.
Yeah, you don't worry about it then until you have your yearly review and just catch up and make sure it's all on track. Absolutely. And it's that, peace of mind that you've got it right. Whereas if you did it for yourself, there's always that part of you going, have I quite done the right thing? Have I chosen the right investment? Have I set it up in the right way? And you absolutely can. I'm not trying to say that advice is the only way. If you feel confident to, and you feel comfortable with investing and you know enough about it, absolutely do it for yourself. It will be cheaper to do. Of course it will, if you do it with no advice. But if you're unsure and you want to get it right, it's often less costly than you think it's going to be. And like I say, it costs nothing for an initial chat with most financial advisors. And from then, you can decide whether it's worth it or not for you. And it's worth having that initial chat, because the worst that can happen is you go, well, it's going to cost me too much, I'm not interested.
No, absolutely, mate. Listen, it's been, you've given some really good advice as it is. I mean, the two main takeaway points there being prepare for the future and protect now. Yeah, fantastic, mate. Yeah. And I think there's a massive percentage of people listening that will have done neither. I'm one of them. That's why, I was more than happy to have the conversation with you, because life can come at you really fast and business comes at you really fast, and it's so easy. I'll do it myself, like thinking I'll get round to that. And before you know it, it's 5 years, it's 10 years, it's 15 years down the line.
Yeah. And then all of that growth that you could have had, you've lost, and all that kind of stuff.
My 1.5 million. But you're right though. It's it comes at you fast, and it's hard to prioritise the future sometimes because it's not here, and sometimes it feels like it will never get here. But if you're lucky, it will. If you're lucky, it will. Not everybody has the privilege of that future. So it's you've given me food for thought, mate. So I'm pretty sure you'll have given everybody else the same.
Hopefully.
Before we do end the conversation, is there anything that you haven't touched on that you wanted to?
Not really, no. I mean, the key things, given your audience, that I wanted to talk about is people in the trade and what you should do. But a lot of the themes that we've touched on are relevant to everyone. The key message above all that I really wanted to get out of this is, if you feel uncomfortable with your finances, talk to someone, whether that's a friend that you trust, family member, or someone who's a professional, because like anything, once you talk about it and you get it straight in your mind, you'll feel much better about it. The stats are there. It's proven that 4 out of 5 people have reported that they feel significantly better after discussing their finances.
Talk about it. Yeah.
And talking about it. If more people talk about money, more people will know the right things to do with their money, and people will be better off in general. So, if you're feeling like your money isn't where you want it to be, your future's not looking how you want it to be, or you're unsure about what you're doing, just talk about it.
It's great advice, mate. It's advice that I've echoed across other conversations. So yeah, let's talk. It's the key to a lot of things. And you're dead right. I think maybe it's a British thing, but we are very taboo about talking about money, what we earn, what we do with it. It is not as out there as it should be, and let's give that a change.
100%.
So because it's only going to help everybody involved. Like you say, the more people talking about it, the more advice that's going to be out there, and the more perspectives we can gain as well.
Absolutely.
Learn from each other.
Yeah.
But yeah, Tom, mate, massive thank you again for your time.
It's been a pleasure.
You've delivered loads of value. Before we wrap up again, just let people know where they can find you.
So Sawbridge Financial Planning on Instagram, or sawbridgefp.co.uk. That's my website. Kind of
Again,
you'll find everything.
Look down below.
Yeah.
It'll all be there.
Yeah, that's where you can find the information.
Fantastic. Before we do finish up, big thank you to our guest merchandise sponsors, The Funky Peach. I will be bestowing Tom with said merchandise. So if anyone's looking for printed workwear, those kind of things, go check out The Funky Peach. They're fantastic. And a big thank you to Steve at Uncle Matt's Hats. Again, another thing I'll be offering Tom shortly. So massive thank you to you, mate. Keep up the good work. Fantastic project. Catch you soon on the next one.